Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, World Cup fever has taken a firm grip on the country, but life and financial markets go on. And today we are looking at two of the Canadian-owned banking giants of the region, Scotiabank, Trinidad and Tobago, and FirstCaribbean International Bank for their half-year performances ended April 30th, 2018. Turning first to Scotiabank, the company reported earnings per share of $1.75, a decline of just around 7.2% from the $1.89 reported in the prior comparable period. And if we switch to our first graph, we note some interesting line items. Net interest income did increase 4.2% from $611 million to $637 million, while total revenues overall increased just around 2.8%. Higher non-interest expenses increasing just about 5% from $330 to $355 million, as well as a higher loan loss expense from $58 to $72 million, contributed to an overall decline in income before tax of 1.2%. Higher taxes as well, with an effective tax rate moving from just around 30 to 34%, also led to a decline in income after tax of 7.2% from $332 to $308 million. How has that revenue line fared? Well, if we switch to our next graph, revenues have been consistently increasing, as we can see in the bright purple column. Retail, corporate, and commercial banking, that particular business segment, has been doing well for Scotia over time, moving from just around $609.8 million in the half year of 2015 to its current level of $817 million. The insurance services business segment has fared somewhat differently, oscillating between a low of $74.7 million in 2016 to as high as $84.1 in the half year of 2017, and its most recent figure was just about $77 million. Now, that's the revenue story is a positive and upward trending, but the profit before tax, as we switch to the next graph, is somewhat of a different story. While from half year 2015 to 2017, there was a nice upward trajectory, the half year of 2018 saw a modest decline, again attributable to higher non-interest expenses as well as increases in loan loss expenses. And the higher non-interest expenses resulted from higher remuneration and staff benefits, as well as the rollout of a new customer retention management platform, which is expected to pay some dividends for the group in terms of more streamlined selling and lower selling costs over time. So at the current price of $65, if we switch to the next graph, Scotiabank trades at a trailing price-to-earnings multiple of just around 18.1 times, above the sector average of 14 times. And this is the price-to-earnings multiple. And in terms of dividend yield, with a regular dividend yield, it's at 3.1%, below the sector average of 3.6%. But including its special dividends, Scotiabank offers investors a trailing dividend yield of just around 4.6%. So in light of an improving revenue story, which we hope will translate into improving earnings story over time, but tempered by relatively high valuations, Bourse maintains its neutral rating on Scotiabank, Trinidad and Tobago. Turning quickly to FirstCaribbean International Bank Limited, and we can switch to the next graph. For the half year ended April 2018, the company recorded earnings per share of just around 35 cents, a commendable increase of 16.7% from the 30 cents recorded in the prior comparable period. Net interest income was up 10.4%, and total revenues were up just around 9.2% to the equivalent of around 1.96 billion TT dollars. Income after tax also increased around 15.7% to $558 million. Now, in terms of the revenue by business segment, as we switch to the following graph, improved revenues or income before tax, by business segment over the last 3 years. And the corporate and investment banking segment has accounted for the lion's share of this profit before tax, or income before tax, moving from $257 million in 2016 to about $357 in half year 2018. Wealth management has had somewhat of a mixed period, from as high as $92 million in income before tax to its current figure of just around $88 million. And there has been a nice rebound in the retail and banking and business segment from $6 million in 2016 to just around $85 million in the most recent half year. Now, a particular point of caution, or in the spirit of the World Cup potential yellow card, is FirstCaribbean's exposure to Barbados. And if we switch to the next graph, we can see that it's pretty significant. One of the major exposures or business interests of the group to the Caribbean region. And by revenue, Barbados accounts for just about 30% of FCI's total revenue, 20% of its total loans in purple, the total liabilities just about 30%, and total assets just around 32% as well. Now, the reason this is a potential caution is that on June 1st, 2018, the government of Barbados did announce the suspension of payments to foreign creditors and plans to restructure local and global debt. They also announced some sweeping measures in terms of increases in taxation and cuts to recurrent revenues, which could have a dampening effect on the Barbados economy in the short term, and by extension, the performance of some of the major business segments and listed companies in Barbados, and indeed in Trinidad and Tobago for those companies that have exposure to Barbados. So at a current price of $8.50, FirstCaribbean trades at a trailing price earnings of around 13.3 times, as we switch to the final graph. And this is in comparison to the sector average of around 14 times. And it offers investors a trailing dividend yield, which is quite competitive, of around 4%, and 5% when you include the most recently paid special dividend, which is above the banking sector average of around 3.6%. So on the basis of that, of more compelling valuations, but again, with the potential caution of the Barbados exposure, Bourse maintains its neutral rating on FirstCaribbean International. That's it for this week's edition. For more information, give us a call at 226-8773, email us at invest@boursefinancial.com, or visit our website at bourseinvestment.com. Have yourselves a great investing week. This has been the Bourse Report.